From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Union 1, Deere 0. Deere's month-long worker strike ends now with a 6-year contract, a 10% pay bump, and a bonus. Is this finally wage inflation? And stocks really fight for a rally. Macy's blowout quarter hurdles the stock to its highest level in 3 years. Alibaba, though, missing estimates, falling the most since December. And oh, sweet Green. Sweet Green finally goes public. We're going to talk to the CEO, Jonathan Neman, later on in the show. From New York, I'm Alix Steel. My co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, we can get into the nitty-gritty in a second, but for me, that Philly Fed Index just pointed to an economy that is super hot, which really echoes what we heard from, say, Macy's and Kohl's. And that, to me, is part of this underlying story in equities.
So I don't know a lot about retailing. I don't know a lot about shops. I don't know a lot about Macy's. But I do know that everybody's been down on Macy's for a long time. So if Macy's is doing well, that tells you that this economy is absolutely on fire and demand is absolutely massive. That Philly Fed number, it's a hugely volatile set of figures. But nevertheless, to your point, it just basically highlights the fact that the U.S. economy is on fire right now. Demand is absolutely strong, huge momentum. And we're going to talk about Deere as well, the labor story in the mix as well. But Macy's is the real tell for me today.
Well, the Philly Fed Index, and this kind of ties into Deere and Macy's, prices received index was up by 12 points. It's the highest reading since 1974. Yet, Macy's and the consumer sentiment may be lower, but the sales are really good. And I think that speaks to the fact that consumers are still willing to spend, which kind of feeds into that wage story.
They're willing to spend at Macy's, which is kind of interesting in itself, but they're also willing to take on the higher prices.
Yeah, true.
You are the discounting experts. I don't think there are many discounts out there right now. People are paying up, and they're prepared to do it. Tells you a lot about the demand story.
I did get a small discount in that Barbie Dream House, though, which is what I really needed the discount on, just so we can say that.
Okay, but it's a small one. Normally, you'd have expected a huge one. Let's talk about that labor story as well, because I think that's absolutely front and center. The other real tell for me today was that Deere story. So Deere union workers, they're going back to work. They're going back to work this morning. Basically, what we've seen here is an ending of this month-long strike. Now, UAW members ratified a new labor contract. That happened Wednesday. Alex ran through some of the details at the top. There's an $8,500 signing bonus. There's an immediate 10% pay bump in the first year. And then basically you've got a series of sequential bumps beyond that. This is, I think, a 5-6 year contract. That's not all. Workers get a 3% bonus every other year. It goes on and it goes on and it goes on. And it basically tells you that labor have the grip on the situation at the moment, which I think is such a big turnaround from the last few decades. So let's kick this around a little bit. Let's get an idea of what all of this is telling us about these markets right now and what you can do in terms of your investment decisions based around it. Joe Doe, he helps lead metals and agricultural coverage here at Bloomberg. He does so in the Americas. Katie Greifeld, Bloomberg cross-asset reporter, writing a fantastic piece about inflation this morning. Well worth a read on the Bloomberg terminal. Joe, let me start with you. Alex framed it this way: UAW 1, Deere 0. Is that the correct way of interpreting this situation?
You know, I mean, listen, if you talk to the company, they probably feel like they won because their workers are back to work. And not only did they start this morning, they started last night, 10:30 Central Time shift. It's the third shift. But yeah, I think on the whole, whether you're talking to analysts or anybody else in the market, they do feel like the workers finally got paid, right? I remember when the second one of the 3 deals that went up, when it failed, I was kind of asking around the market and various union workers, why did this fail? Like, what specifically, what's the nitty gritty? And somebody explained to me, you know, Joe, you're missing the point. It has gotten personal now. We are recovering from the pandemic. It has been years where Deere workers and many other union workers took pay cuts for a couple decades. And now they're just saying, you know what? We were essential workers during the pandemic. We put our lives at risk to be in those factories. Pay us. You are seeing EBITDA, you are seeing profits at levels that you've never seen before.
Yeah, and Joe, I have to wonder if this is a Deere-specific thing, or do you think it's going to go to some of the other companies? Because, quite frankly, I've heard of, strikes in Hollywood. My goddaughter had to strike because she works in Hollywood. I know that there's museum worker strikes. Like, it's really a broad-based thing.
Yeah, it really comes down to, when does your collective bargaining agreement end? And I mean, listen, I was talking to some folks inside Deere who said, hey, our collective bargaining agreement is due up in 2023. So maybe mark that on your calendars, right? I think it really is, timing is a part of this. I mean, this is a conversation that we've had a lot at Bloomberg about the broader labor story. And if your contract is up now or maybe in the next year, your company is going to probably have to have quite a long negotiating period.
Katie, the market by and large, though, the equity market, the capital market, seem pretty comfortable with the inflation narrative that we've got thus far. Like, to Joe's point, what he's basically saying is this is going to go on and on and on. Labor wants more, and that is going to be sticky. Do you think the market at this point has got a grip on what is coming towards it?
I would say it depends on which market you're looking at, because to your point, I mean, stocks seem totally comfortable. The S&P 500 up 25% this year, the VIX near the lows of the year. But if you look at the bond market, that's where things get a little funky. And especially if you look at implied volatility in treasuries right now, that is at the highest level since April 2020, which is never a good size and scope when we're talking about volatility. So I think the bond market is looking at the inflation on the ground, the inflation that's expected to come, also trying to suss out who the Fed chair is going to be next year. And you're starting to see much more anxiety in that market than you are in equities right now.
Which is so interesting, because Howard Marks was talking to Taylor Riggs yesterday, and here's part of what he had to say about the S&P, but also how he is positioning for inflation.
Oaktree is certainly not taking a strong position on the assumption that there will be a lot of inflation and that we have to avoid it. We are doing our normal thing. We certainly have not inverted our portfolios to prepare for inflation.
What did you make of that, Katie?
It's interesting. I mean, it really depends on who you're talking to and what their time frame is. So in this article I have up for Bloomberg Business Week, I spoke to someone who said that she feels totally comfortable because she's looking 3 years out. She's picking companies based on balance sheets. But if your timeline is a year, this is the call you have to get right. Whether we are going to see this spiral in inflation, maybe driven by wage pressure, or whether this really is going to be transitory. It's something that's going to cool down, peak maybe in February. I know that's Citigroup's call, but I mean, if you're trying to manage money around this, this is the question that you have to answer.
One of the things that I think the market's beginning to pick up on as well is the idea that actually food price inflation is starting to rise and rise fairly rapidly. You're seeing wheat, I think, is at a 9-year high, Alex. I think you've got a situation where you're starting to see a bunch, I think it was coffee the other day, hitting a 7-year high. That's a major crisis. Joe, when we think about Deere, I was looking at a chart as well of used tractors earlier on. I think that they're up by 25% this year. Input costs are up massively for the food industry. There's the wheat futures story. In terms of what the near-term effect of a Deere strike is, a Deere strike sounds like something you do in your car, but a Deere strike does in terms of the food industry. What is the translation effect, like the input cost story? Because people are starting to feel this in the grocery stores.
Yeah, listen, I mean, Deere union workers were very aware of this point, right? Like, this is I've heard so many times people say this was a perfect storm. You have global supply chain issues. You have companies trying to ramp back up production to meet the unbelievable demand that they just did not see coming in 2021. You have the rise of commodities. I mean, I cover the metals industry, cover the ags industry. You look across the board, everything is up. Every day we're saying, what's the next redhead, right? What's the next big headline about prices being up? And I think you look at Deere, you have workers not working, right? I mean, we reported that parts were taking weeks to get to farmers at the peak of the harvest, right? The busiest time of their farming season, instead of 1 to 2 days. And it was all of these things compacting into one. And that's why you started hearing farmers say, we want these people back to work as quickly as possible because we're getting it on all ends on the price curve, on the price levels.
Hey, Joe, I'm wondering, the contract is for 6 years. So I'm just wondering, does that in some way cap any kind of wage inflation? Because if inflation actually runs hot, we're going to need a lot more wages to keep up with it, right? And that's sort of the dynamic that Katie is also talking about in the market. And I'm wondering if, because the price increases is like just 3% and then 5% down the road, does that change the dynamic? What do you think?
Yeah, and listen, I mean, Katie's looking a lot more macro than if we were just looking at Deere. Deere's 10,000 workers, right? I mean, this is on the grand scale of thing, not a lot of workers. And then you also have to ask, well, how many unions are actually up for, contract negotiations? And that's where we start asking internally at Bloomberg, like, is this labor wide, right? This is a moment. We feel like this is a moment. But how widespread is it? And I think the markets are still trying to figure that one out. I don't think anyone is saying, yes, for sure, we're going to see this wage inflation go not only in 2021, but 2022 to 2023. And I think that's one of the things Katie's kind of getting at is some people are just saying, well, hold on a minute. We've been around these markets a long time. There's a lot of people who do remember seeing wage inflation, back in the 70s, but it's been a while. But I don't know if we can quite say for sure that we're going to just see rampant wage raises going on for years. But maybe I'm wrong. I mean, this has been some sort of a shift or sea change that we've seen this year that really we haven't seen, especially in the manufacturing space, probably for 30 to 40 years.
Wow.
Yeah, and that's the point, isn't it, Katie? That this is a once-in-a-generation shift. There are people I'm 50, there are people my age that vaguely remember inflation, but never really had to deal with it in the office. There's a huge number of people that are younger that have never even seen inflation, never seen interest rates in the teens, never seen house prices going up at kind of similar amounts as a result of what is happening here, and asset prices reacting. Katie, is there the institutional memory that is in the market that is capable of kind of contemplating such a big pivot?
Well, that's part of the worry, because if we're talking about core PCE, we're talking about headline CPI, it's at the highest level since 1990. I mean, 3 decades. Even if you've been managing money for 10, 20 years, you probably haven't seen this in a long time, and you haven't had to deal with this. And I mean, the risk is that we do end up going back to, what we were seeing in terms of the late 60s to the early 80s in terms of how the bond market reacts, how the equity market takes its cues, and whether that institutional memory is there. I mean, again, we're talking in terms of decades, so it's definitely questionable.
And if that's enough to kind of move the market then. All right, Katie, thanks a lot. Joe, thank you as well. It was a really good conversation. We appreciate that. We're going to have more about inflation, how it's showing up in food prices. We're going to talk to Jonathan Neman. He's a Sweetgreen CEO. He'll be joining us later on in this hour. Coming up right now, how do you hedge your portfolio against all of this? Anastasia Amoroso, iCapital Network's Chief Investment Strategist, joins us next with her strategy. This is Bloomberg.
Not only have rates come down, bringing with them the prospective returns on all securities and all investments, not just bonds, but at the same time, markets have become more efficient. It's not easy to beat the market these days, and the margin of superiority, to the extent it exists, is smaller. That's the definition of efficiency, and you must expect that markets will become more efficient over time, as this one has.
That was Howard Marks, Oaktree Capital co-chairman and co-founder, speaking to Bloomberg earlier yesterday. Joining us now, Anastasia Amoroso, iCapital Network's Chief Investment Strategist. Easy money's been made. Take a look at what happened with Deere and wage inflation. Hot economy. How do you hedge it? How do you hedge inflation?
Well, I think it's the critical question to ask for 2022, because hedging inflation this year has not been a problem. If you look at equity returns, we're up 25%. And even though fixed income has done pretty badly, you still have a 60-40 portfolio that probably is giving you about 15%. But I don't think that's going to be the case next year. So if inflation persists next year, and most economists agree that it will, we're still expecting inflation of 4.6% next year. That means that hurdle rate for your investment returns has to at least beat 4.6%. But when you look at consensus, Alex, and you look at the expectations for the S&P, we might get a 9 or 10% return. And if you look at bond prices and where they might be headed, there's probably going to be another year of declines. So my point is that the 60-40 portfolio is just not going to be enough to beat inflation and deliver returns in real terms. So that was a long-winded way of saying is that you need to look elsewhere for those returns. And there's three things that I would point to. First of all is real estate. Second of all is private credit. And the third one is crypto, I think has to be a part of the inflation hedge portfolio. But real estate, many people probably do have an allocation to REITs, but it's small, right? It's 3% of the S&P. So the area that we're looking at is in private real estate, where you get sectors like apartments or leisure and hospitality that give you a pretty good inflation pass-through.
Yep. So there is an alternative to equities, is what you're saying?
Yes, there is an alternative to equities, and I think investors need to increasingly look there. Obviously, that's been a big part of our discussion with clients is what's the alternative to the 60-40. So I like real estate, I like private credit because we badly need, an alternative to fixed income as well. As I mentioned, if you look at the global bond market performance, you're probably down 2.2% for the year.
So Anastasia, just to be clear, you're talking about the 40, you're not talking about the 60. The 60 is still in equities.
Well, the 60 is in equities, and I think the 60 is going to be fine in terms of delivering the 10% return. The 40 is not going to be fine. It might deliver a negative return, but you blend the two together, you're not going to get a very high rate of return most likely next year. So the things that you might want to do is peel a little bit from the 60 and allocate to something like cryptocurrencies, because if the portfolio has a chance of beating inflation, you have to have hyper growth in the portfolio. And if I look around the world today, if I look across disruptive technology, that hyper growth is happening in cryptocurrencies. I mean, look at the returns this year. In crypto, it's something like a Bloomberg DeFi index is up more than 200%, I think 250%. So this is clearly where that growth is happening. And the problem is inflation. It's not just denting your disposable income, it's denting the real return and the real value of your portfolio.
So I'm trying to understand then sort of what crypto follows, because sometimes it seems like it's following gold a little bit, and then other times it feels like it's following large cap tech. So it's more of the growthier thing. So how does that help as the hedge?
Yeah, Alex, it doesn't unfortunately fit in neatly in any one category. When you think about something like Bitcoin, it probably has most of the classic inflation hedging characteristics because we know that it's supply constrained, and as long as the demand and adoption of it continues to rise, that should do fine. But the way I think about it is really, what is the space that can deliver that hyper growth? And it is crypto. So I do think that for most investors, it's more of a tech play. It's more of a growth play than maybe it's a classic kind of a commodity currency play. And by the way, when you look at technology, one way to value technology, like we were doing in the early days with Facebook and Netflix, is the network value. So it's all about adoption. It's about the number of new wallets, the number of new addresses. And we've seen that number surge this year. And I think there's a lot more potential ahead.
So David Solomon yesterday, over at Goldman Sachs, CEO, was talking about the fact that fear and greed are out of whack, that greed is basically in charge and is in the driving seat right now. You're talking about looking at alternative ways of valuing some of these assets. And many people will say, well, that sounds exactly like what we were talking about in 98 and 99. Do you think fear and greed are out of whack here?
I think there's definitely performance chasing. I do think there's a lot of greed that has crept into the market. I will say, you look at something like call buying, call options, we saw the net buying in the top 2% since 2000 the other week. So there's definitely some aspect of chasing here. But you have to step back a little bit and to go back to crypto for a minute. If there is 100 million Ethereum and Bitcoin addresses right now, what is that 100 million going to do? Is it going to go to 200, 300 more? And I think the answer to that most likely, yes, it will over time. There's over 5 billion adults worldwide. So I do think that potential adoption curve is pretty significant. So, Guy, maybe near term, you could definitely make an argument for a lot of the assets, not just crypto, but equities, semiconductor, software. Maybe that has run up a little bit. It's a little bit too stretched. So I would not be shocked. In fact, I would love to see a pullback in some of those risky assets, but it is a pullback that you would want to buy given what lies ahead in terms of adoption.
So it's not 2000, or is it?
I don't think it is 2000 in many ways. Probably one of the most significant ways. If you looked at 2000, you had interest rates that have been hiked significantly leading up until then. And as a result of that, you actually would have been better off in the bond market versus the equity market. And that's just not the case today, given where real rates are and given the Fed that is not really rushing to hike them anytime soon. I think it is just a very supportive environment for markets. And look, I'm sure there is plenty of young and unprofitable companies that are commanding stretched valuations, and that's something that we need to be aware of. But I think the amount of disruption, the amount of innovation, the amount of opportunity is really significant.
All right, Anastasia, thanks a lot. It was great to see you in person, too. Thank you so very much. Anastasia Amoroso of iCapital Networks. Thank you. Guy, here, stocks really rolling over. Cisco really leading the decline. Salesforce also lower as well, and some of the large cap names.
Absolutely. You've seen it from the get-go, really, in Europe. We've been down from the start of trading. There's the stock 600, as you can see, really nosing over now. It's been some of the old stocks that have been doing it. It's been some of the heavyweight miners that have been doing this. You have to take a step back, though. What was the number there? 487. We were at 490. Record highs still aren't that far away. We're kind of bouncing around. But nevertheless, a little bit of a sell-off, and it's on okay volume. The volume's kind of mixed across Europe. It's better over in the United States. What are we going to talk about next? Nvidia, the chip sector, absolutely hot right now, surging to a record. Its growth in the last 8 quarters now makes it 3 times the size of Intel. We're going to talk more about that next. And this is David Wilson. This is Bloomberg. Stock of the hour, Nvidia. Dave Wilson, over to you.
Fiscal third quarter results went over well. Earnings and sales beating analyst average estimates in the Bloomberg survey. Fourth quarter revenue outlook, same story. And it's all about data centers at Nvidia. That's the fastest growing area of the business. 55% increase in revenue in the latest quarter. Overall, 50%. 6th straight quarter where they had that kind of increase. And Nvidia, which took over last month from TSMC of Taiwan as the biggest chip maker in the world. Now, that gap is now about 30% after these results. And if you look at companies this year in terms of market value increases, Nvidia has now jumped to 3rd. It was 4th as of yesterday. Only Microsoft and Google's owner Alphabet have added more market value. So it's just Nvidia's on a roll.
Yeah, no kidding. Definitely on a roll. Huge market cap. Now, hey, Dave, thanks a lot. Really appreciate it. Bloomberg's Dave Wilson watching Nvidia stock up by about 9%. All right, coming up, salad chain Sweetgreen goes public. So we're going to talk to the CEO, Jonathan Neman. That's coming up next. What is he going to do with the money? What about inflation? This is Bloomberg. Live from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. We are about an hour into U.S. cash trading. Kriti Gupta is looking at where we stand. Kriti, we are rolling over now.
We are, and we started green on the screen thanks to those chip makers in particular, but you can really see it was the rest of the market that started dragging the indexes lower, not just here, but over in Europe as well. You can really see it is a risk-off tone. You're not seeing that, though, in treasuries, which was really flat on the day. Yields not moving anywhere, really in anticipation of whether or not we're going to hear about this new Fed decision. Is it going to be Lael Brainerd? Is it going to be Chairman Powell again? We don't know, and you can see the treasury market really just bracing for that. But where all the action seems to be, Alex, is going to be in the oil market in particular. After days and days of trying to find some way to really get those oil prices lower, it looks like Joe Biden has had some success talking about a potential reserve release, not from the United United States, but over from China, one of the results of the conversation between Xi Jinping and Joe Biden as well. So you can see it is that's kind of pressuring oil prices just a little bit. But the question is how much and when is it coming? So that's where you're seeing a little bit of choppiness intra-session today. Let's get to some of those micro movers, though, because those earnings stories are still trickling out hot and heavy, especially when it comes to those retailers. You do have Macy's up a whopping 17%. Same story with Kohl's, up almost 7%. The story here, beating their earnings, a positive holiday forecast. But here's the difference. Macy's talking about expanding their digital marketplace, using that buzzword, e-commerce. And that's why you see that 17% increase in Macy's at the moment. A different story when it comes to Victoria's Secret and Bath & Body Works. Remember the two spin-offs of limited brands in particular. Victoria's Secret, once again, 14%. For them, the story is a little bit different. They beat expectations when no one thought that they would. So coming into that, they are having a pretty good boost. I'm going to end here with the tech story in particular because Nvidia was the big market mover intraday. You did see that up, expanding their business from gaming into data center chips in particular, and ending with Cisco, which of course missed their estimates, blaming those supply chain concerns.
Crudy, thanks very much indeed. There are some reports suggesting that this sell-off may be down to the fact that we are seeing Joe Manchin tweeting that his votes around Build Back Better, the second part of the Biden plan, by no means locked in. I don't know why anybody is surprised by that, but it looks like that could be the case.
Yeah.
He's proved a little tricky when it comes to corralling him with the rest of the party. We'll see what happens next, Alex.
Yeah. Also, I should point out that there's a lot of options that expire tomorrow. So there's going to there's volatility around that too. So we can't discount that part, and volume's thinning out. No,
I think it's going to be a real bumpy one tomorrow. Really bumpy tomorrow. So it could be a fun Friday. We'll see what happens. Let's talk about an IPO that is happening today. Salad restaurant chain Sweetgreen going public. It's doing so on the New York Stock Exchange. It's raised $364 million in an above-range IPO. The business founded back in 2007. It's got 140 locations. It now operates across 13 states. Joining us now from the New York Stock Exchange is Jonathan Neiman, Sweetgreen's CEO. Jonathan, really appreciate your time today. Thanks for taking some of it to talk to us. Look, you set up the business a while ago. You've obviously been working towards this moment. You're IPOing the business. Now what?
Well, first of all, thank you so much for having me. You know, over the past 14 years, Sweetgreen has built an amazing brand, supply chain, tech capabilities, and most importantly, culture and team. And we believe we're at a very exciting inflection point. As you mentioned, 140 restaurants across 13 states, but we have a very big mission and very big vision. Our mission is building healthier communities by connecting people to real food, and we'd like to transform fast food and make it healthy. So the current plans are to double our footprint in the next 3 to 5 years, and over time create a massive global iconic brand that changes the way people eat.
Hey, Jonathan, congrats on the IPO. Still waiting for it to trade. Where are you going to be building? You're obviously very much geared towards urban centers, and we've seen a lot of people sort of relocate to the suburbs, particularly during the pandemic, and a lot of work from home. How do you take advantage? What do you do with that?
Yeah, so we started the business in Washington, D.C. and really intentionally wanted to open in a lot of the major cities around the country, whether that be New York, Boston, Chicago, Los Angeles, and San Francisco. But over the past few years, we have expanded our reach to many more communities, including Colorado, Texas, Florida, and we are really excited to continue to meet our customers wherever they are and follow them home. So Sweetgreen has successful stores in both urban and suburban markets, and eventually we would like to be everywhere. So we're looking to open new markets every year and bring our healthy offering to more and more communities.
How do you think that Sweetgreen should be valued? Are you a tech company? What kind of a company are you? I know you've got the Spice acquisition, which I think you are still incorporating. What kind of business are you, particularly with kind of rolling Spice into the business? Do you think, how should investors see you?
So first of all, Sweetgreen is a brand and a food company first. We leverage technology in order to make it a better consumer experience and a better experience for our team members. Whether that be our 5-channel model and having multiple ways of ordering from a customer perspective, the software we build inside of our kitchens from a supply chain perspective to create a more efficient working environment. And eventually we do believe automation can help create a better working environment for our team members while creating a better experience for our customers with faster speed of service and many other attributes. We're very early in our development of automation, but very excited for what that can do over time.
Jonathan, does that mean that you're going to replace workers with robots and a robot's going to make my salad?
We're actually not going to replace workers. We believe the workers will work side by side with humans and elevate the job of humans and allow us to open many, many more restaurants than we would without it, thus creating many more jobs. Today we have 5,000 passionate team members, and one thing I'm really, really proud of is yesterday, right before going public on the eve of our public offering, we did what we call a gratitude grant, an equity grant to every single team member in the company. That means from the dishwasher through the executives, every single person received equity, so they are an owner in Sweetgreen as we look to expand.
In terms of those team members, what are they earning now versus what they earned a year ago? Are you struggling to find people? Is there a labor shortage that you're struggling with? Just give me a sense of, from an operational point of view, where the struggles lie.
So, of course, as you read in here in the news, labor has definitely been challenging for our industry. However, people want to work at Sweetgreen. We have a mission-driven brand and amazing culture that people are attracted to. A lot of growth opportunities with the number of stores we're building. You can come join Sweetgreen and within 3 years go from a core team member to a general manager, or what we call a head coach. On top of that, we have best-in-class pay and benefits, including parental leave for every single person that works at Sweetgreen. We pay above market rates for all of our team members, and like I said, we offer things like equity as well. So we're really proud of the working environment and what we do for our team members, and they are our most important ingredient. They are what makes Sweetgreen come to life every single day.
In reality, though, the ingredients are actually like salad and stuff, and vegetables and things like that. Guy and I were talking earlier about wheat prices being high, coffee prices being high, soybean prices being high. How are you managing the cost inflation right now? How long do you think it lasts for?
You know, Sweetgreen is a really interesting supply chain. We have over 200 domestic and suppliers and partners made up of both small, medium, and large partners. We really focus on the relationship with those partners, thinking about the soil health, the nutrition, and the taste of that food. Because of the way we've set up our supply chain, while there's definitely been challenges that we face like everyone else, we've been able to navigate it really well and have a lot of resiliency in our supply chain. So I'm very proud of the way our team has navigated and the way we've taken care of our farmers and partners along the way.
So you've got more suppliers than you've got outlets right now. Do you think ultimately that balance changes? Do you think ultimately you will have to consolidate some of those suppliers?
No, we look to build both a national and regional supply chain. So we have national partners as well as regional and local partners in every city we go to. So as we continue to scale, we would love to bring more suppliers onto our network, but we'll also be able to leverage the suppliers that we have today. Over 60% of the suppliers we have today, we've been working for multiple years at a time. So we're really proud of those deep relationships and what that does to bring the Sweetgreen experience to life.
Jonathan, thanks a lot. We appreciate it, waiting for that stock to start trading. We appreciate you the time today. Jonathan Neman, Sweetgreen CEO. All right, coming up, Kriti was mentioning it. Oil prices rolling over, but is it going to be enough? U.S. propane prices are also dropping from those October highs. So have we hit the top? Are the worst fears about a winter shortage actually overdone? We're going to break it down with Suburban Propane CEO. He'll be joining us next, Michael Stavala. This is Bloomberg.
This is Bloomberg Markets. I'm Rishika Gupta, and you're looking at a live shot of the principal room. Coming up, US Senator Rob Portman, 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Rishika Gupta. The leaders of the US, Canada and Mexico will hold their first in-person meeting since President Biden's election. The three will meet at the White House today. Amongst the issues likely to be discussed, energy borders and auto manufacturing. Trade disputes remain despite the rewrite of the North American Free Trade Agreement. In Canada, the city of Vancouver has been cut off from the rest of the country by land due to flooding and mudslides. Major highways and rail lines going in and out of Canada's third largest city have been blocked after what local officials call the storm of the century. That's led to panic buying at grocery stores. And inflation's on the mind of bankers around the world. Economists at JP Morgan now expect the Fed to raise interest rates next September. JP Morgan is the latest Wall Street bank to abandon an earlier forecast that the Fed would stay on hold through next year. Meanwhile, the CEO of HSBC also sees rising prices as a big issue. We talked to Noel Quinn at the Bloomberg New Economy Forum.
I am concerned about inflation because I think at the same time as the supply chain recovering, there are some new issues. Supply chains are repositioning, partly because of geopolitics, partly because of resilience considerations by governments. Oil prices are going to remain high for quite a while.
And after hitting what was a 7-year high, oil prices have eased over the last 4 weeks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. So let's stay with oil prices for a second. Will it be China that's going to further help ease those concerns over higher oil prices? China does say it will release some of its strategic petroleum reserves to help the global energy markets. Joining us now, Emery Hordern from the White House. Emery, did the Biden administration do this? How did this sort of come about?
We don't know yet because China has done this in the past, and they recently did it in September to the tune of a little bit north of 7 million barrels. But the timing is interesting, and it comes off the heels of President Biden and that virtual summit with Xi Jinping, and they talked about energy security and the volatility. And then the next day, we heard from National Security Advisor Jake Sullivan, and he said that the two leaders agreed that they would work on energy and task their teams expeditiously. And then what do you have? Just 24 hours after that, China looking at tapping their strategic reserves. It is a huge win, we should say, for the White House. They have not have to tap their own reserves just yet. Just corralling consumers and the threat of it has been able to push down prices.
So are we now in a situation where you've got a cartel of producers, we call it OPEC, OPEC plus, and now a cartel of consumers?
I wouldn't go that far yet. I wouldn't say it's a cartel of consumers. We only just heard from Beijing. We still need to see what maybe India, South Korea, Japan, and the United States will do. I think the question is the verbal intervention enough, or will the U.S. have to actually go tap the SPR to try to put a lid on gas prices and, of course, ease concerns for consumers at the pump? Because that's really the president's biggest problem, those rising prices in gasoline and groceries, and just the threat of higher inflation still yet to come.
Groceries and gas. A lot of people pay attention to that. Emery Hordern, thank you very much indeed, joining us from the White House. Let's stay with the energy theme. Propane prices in the US have actually dropped from their recent highs. We're down by around 25% off the October highs. So our concerns over a winter shortage story kind of a little overdone. Suburban Propane operates in 41 states and is one of the largest propane suppliers across the nation. Its CEO is Michael Stivala. He joins us now. Michael, really appreciate your time today. It is perfectly timed, this conversation. October saw the highs. We faded since then. Are we going to be okay this winter, or are we going to revisit those highs, do you think?
Well, first of all, thanks, Guy, for having me this morning. Really appreciate being on the show. Look, the supply situation in the U.S. is not necessarily what I would consider temporary. Okay, there's three real factors that are playing into the current supply situation for propane here in the U.S. One, you have to look back at pre-pandemic activities where you had a significant ramp up in the industrial complex in Japan, in China, and other parts of Asia, as more and more production of the goods that we need every day was coming from overseas. Mm-hmm. And so that significant ramp up in manufacturing activity in Asia, a lot of that is fed by NGLs that are exported out of the United States, and propane in particular. On top of that, recently, obviously, we've seen a significant shift in energy policy and significant regulations placed on the oil and gas industry, which has really made production and refining activities very difficult in this environment. And so that's not allowing the production to keep up with some of the demand.
So Michael, on that point, let's just pretend that the U.S. does release some oil from the SPR and that China does the same. Does that materially impact what you do?
Certainly not what Suburban Propane does. We're a retail distributor here in the United States. We serve 1 million customers for their home heating, cooking, clothes drying. We serve commercial industrial customers. So we are a domestic provider of energy to our consumers. Let's face it, the release of strategic petroleum reserves ultimately needs to be refined. So the move just to release reserves is not going to immediately impact the supply of propane here in the United States until ultimately it gets refined. And I think that's where some of the regulatory framework can get in the way. The other aspect is we are exporting a significant amount of propane out of the United States into Asia. Exports have typically ranged in the 1 million barrels a day range. And over the last several months, as economic activity has increased, we're touching closer to 1 million, right. 1.5 million barrels a day of going overseas.
Wow.
Michael, do you think the president should say enough's enough and say, actually, we're going to put some export bans on? Do you think that propane should be staying in the United States?
Look, I'm not a proponent of bans, from an export perspective. I think I'd rather see a little bit more regulatory relief to help out some of the situation. I mean, certainly, if the situation here in the United States gets to be very challenging, then that could be on the table. But the reality is, it's all going to be driven by the weather. Okay, the last time we were at propane prices that were this high in November was in 2011. And it was almost the same pricing structure. And we happened to hit the warmest winter, one of the warmest winters on record for 2012. And that ultimately significantly brought prices down immediately. By February, prices were almost a third below where they were in November. So a lot's going to depend on the severity of the winter weather that's coming up, where the weather occurs, and how sustainable we get challenging weather or traditional winter weather.
So, Michael, later on today, you have AMLO, Justin Trudeau, and President Biden are meeting. And something that's going to be talked about, most likely, is Line 5, which is a pipeline that runs from Canada to Michigan. Propane is on it, and oil is on it. Do you think that closes, or does it live?
Well, I sure hope it lives. I think it's very misguided thought that we can do without the amount of propane and oil that comes in from Canada to serve some of the critical needs, particularly in the upper Midwest there. I mean, that line is a significant contributor to the energy needs, particularly of Michigan, Wisconsiners. And I think if that ultimately gets canceled, that can be a real significant constraint on the energy needs in that particular part of the country.
Michael, how much of the propane that's being used in the United States at the moment is related to outdoor dining? COVID's starting to make a return in certain parts of the United States. Outdoor dining could be a feature once again this winter. Where is the propane that you're selling being used right now?
Well, we've seen a bit of a normalization in propane demand over the course of the last 12 months. Right when the pandemic hit, you saw commercial industrial demand just completely crater. And we were surprised and pleasantly surprised by the residential sector that picked up significantly on that on the demand side, both because of the stay-at-home initiatives where more people were in their homes and therefore using their heat, but also the outdoor activities. And through the summer of 2020 and ultimately into the fall of 2020, we did see a significant change in outdoor dining activities that brought demand for propane. But as we got into the winter of 2021 and we started to see some of the COVID restrictions easing, businesses opening up again, we saw a real normalization of demand where commercial activity came back, industrial activity was back, and residential sort of got back to a more traditional heat-related demand.
Right.
Yeah. Michael, thanks a lot. Really appreciate it. I've just walked in all the restaurants here in New York to see all that propane. Michael Stavala, Suburban Propane CEO, thanks very much. We're going to have more on oil and gas prices and the SPR release on Commodities Edge just coming up at 1 p.m. in New York, 6 p.m. in London. Don't miss that today. This is Bloomberg.
From London, I'm Guy Johnson, Alix Steel over in New York. Let's take a look at where European stocks are. We're heading into the close. We're fading into that close, but there's some single stock names that we really need to talk about and dig into. Hermès, the French luxury giant, trading really strongly today. JP Morgan suggesting maybe, just maybe, this is a stock that gets put into the Euro Stoxx 50. That certainly would provide a huge tracking boost. ThyssenKrupp, the steel giants, up by 7%, let's call it. Good set of numbers today. People are a little iffy on the free cash flow outlook statements, but nevertheless, this is a company that still has an awfully long way to go to the sum of the parts valuation that people talk about when you break this business up. We talked about it earlier on this week with the hydrogen story. And here's my story of the day. Naked Wines down by 5.2%. The reason? We're all going to bars. We're not drinking at home. Alix Steel is still drinking at home. This is Bloomberg.